Welcome to Great Quarter Guys, a series of quarterly episodes where participants react to earnings week and express their opinions, both positively and negatively, on quarterly earnings calls. The views expressed by the hosts and panelists are solely their own opinion and do not reflect the opinion of Ritholtz Wealth Management, LLC. The information discussed should not be relied upon as a recommendation to buy or sell any of the securities discussed. Investing involves risk and possible loss of principal.
Hello, everybody. My name is Michael Batnick. Hello, guys. Welcome to Great Quarter Guys. The stock market doesn't move on good news or on bad news. It moves on better or worse news. The best day for the S&P 500 over the last 3 years was on November 10th, 2022. What happened on that day to drive the stock market 5.5% higher? October's CPI came in at 7.8%. 7.8%. That's one of the highest monthly numbers in the last couple of decades. But it wasn't as high as September or August or July or June. It's not good or bad. It's better or worse. The most important variable that drives individual stocks and therefore the stock market are earnings. Again, not good earnings or bad earnings, but better earnings or worse. Specifically, better or worse than analyst estimates. We hear from companies 4 times a year when they present their earnings from the past quarter and give guidance for the future. Sometimes these numbers are in line with analyst estimates and the market has a ho-hum reaction. Other times, like yesterday with Meta, they blow out any and all expectations, even the most optimistic ones. Estimates are then ratcheted higher as the stock price leaves analysts in its dust. Meta is up 20% today, adding more than $200 billion in market cap after a blowout earnings report. Josh and I wanted to create a show where we can go past the headlines and really dive deep into what's moving the biggest names on Wall Street. We're going to break down the earnings calls with some of the brightest minds that cover each industry that we're going to be talking about. So on today's pilot episode, where we'll go over Tesla and Apple, Amazon, Meta, Alphabet, and Microsoft, we have Alex Kantrowitz and Dan Ives. Both have been on the Compound and Friends before, but for a proper introduction, Alex has an incredible Substack and podcast called Big Technology and is a frequent guest on CNBC. Alex, you had Vlad Tena from Robinhood the other day. That was awesome. Congrats on that one. Dan Ives is a managing director and senior equity research analyst covering the tech sector at Wedbush Securities. And Dan is, quite frankly, don't blush, the hottest tech analyst right now on Wall Street. Gentlemen, welcome to Great Quarter Guys. And just one note, just before we start the show, the name of the show is an inside joke, Great Quarter Guys. It's a nod to something that analysts frequently say before they kiss ass to management. This doesn't mean that every company we're going to be covering had a great quarter. In fact, quite the opposite. And that's a great segue to start with the first company that we're going to be talking about today, which is Tesla. Dan, let's start with you. What did you think of the recent earnings report from Tesla?
Look, I thought the actual numbers itself were actually relatively strong. You know, in terms of units, where they sort of guided, you know, in theory for the year. But the biggest problem was communication on that call. You know, didn't really put a line in the sand around margin. That was really the big issue, right? Because right now, the street's focus, when do the price cuts end? Where's the line in the sand? Hold the margins, and then we move forward. And I think that's why the stock, I mean, we talked, it was a train wreck conference call. 80% of the reason the stock was down was communication, but the story is well intact. And I ultimately think this is really, you know, I think just an inflection point to the next stage of growth.
Dan, can I ask you, this is a company that has had this miscommunication thing hanging over it before, but investors have been able to look past all that. It's not as though Elon has been a masterful communicator at all times. What do you think has changed, and why are shareholders now, I think for the first time in 5 years, really starting to second guess the things that they're talking about on these conference calls 2 in a row?
Yeah, and look, ever since Zach, the CFO, left in August, it's been a debacle in terms of communication. And look, Elon's going to be Elon. Elon's never going to start to talk about margins, what the trajectory looks like in the second half. But when you don't have an adult in the room, that's where it's all gone off the rails. And investors, the story in terms of AI, more mass market, a sub $30,000 vehicle, like that story is well intact in terms of, I think, the next stage of growth. But in this type of hand-holding period, if you don't get handled, Street's going to assume the worst. And that's kind of what we saw take place here in terms of, I think, just a lot of frustration that I've heard, countless from investors.
So the stock had dropped 9% at the day after it reported earnings. It's now 55% below its peak. And Dan, I read your note saying that it was a disastrous earnings call. From my point of view, I'm not a professional, obviously, analyst. I don't listen to every Tesla earnings call, but I did listen, and I was a little bit surprised to see that there wasn't more pointed questions, really at all, about the price reductions in a lot of the cars. Alex, as you listen to Elon, were you surprised at the lack of questions about those margins and what they might mean for the future?
Yeah, of course. I do think there should be more questions on the margins, but also more broadly, like if what it took the street to give up on Tesla this way was just that they weren't handled by a CFOs, then how do you really evaluate their position in the first place? Like, to me, and I'm curious to hear Dan's perspective on this as well, everybody's perspective here. Like, isn't this the ultimate buying opportunity? Like, if you really believe in Tesla and if you believe that big story is going where it needs to go, right? Like, Dan, you mentioned that they didn't get into specifics. They talked about the big story, but isn't this like they're under 600 billion now? Dan, you had them going to $1 trillion this year. If you believe that, okay, maybe they miss on the margins a little bit. Like, maybe it's, going back to your question, Michael, maybe it's not as consequential as we were making it out to be. Like, maybe we don't really care about the margins. If, what the big deal is that they're making this move towards being the leading electric vehicle, one that's going to roll out self-driving, is well on its way. And if you're not a believer in the stock, then you're going to be out. But if you are a believer, this would be the time to double or triple down, don't you think?
I mean, Alex, that nails. Look, and I talked about it on the compound in terms of when we went into detail, but you're going to have moments like this. We call it white knuckle turbulence. You navigate through because our checks and where we see the story go. And I think when I look at Tesla, it's no different than Meta 18 months ago. I could go to other examples of Apple. This is not the time to panic. I think we look back, and this is actually more of an inflection point where we realize the margin story started to turn. And I think the next phase of growth starts to factor in. But you own it for AI. And now, and we could talk about it separate, but with the Delaware situation, I think Tesla's going to Texas. They're going to give Musk to 25%. And I think ultimately this is really going to lock him in the AI initiatives, and that's going to be the next stage of growth.
Hey guys, if you think about 2022, two of the greatest stock market bottoms ever for tech stocks. One was in May when Netflix disappointed, and I think the stock had come down from 600 to 120 or something. It was just a remarkable moment of destruction, but that was the double down moment. And then later in the year, October 31st, there were analysts on TV crying about Facebook, about Meta. And that turned out to be one of the great buying opportunities of all time. Tesla, the chart doesn't look great, but it doesn't look as bad as Netflix in that moment and Meta in that moment looked. So I guess, is there more to come? Is there a worse moment, AKA a better buying opportunity? Or do we think we've seen as bad as things could get here?
I'll just sort of tap in. In my opinion, this essentially is the bottom. I'm not saying the stock can't go a little lower here, but they've cleared the decks. The street just absolutely torched numbers. The decks cleared. Sentiment's awful. The hate mail is up massively from institutional investors. And what I love is that the story in terms of AI, mass market, where they're going, but it's all intact. And Alex and I have talked about this many times offline. We view things similar. You got to see forest through the trees. Can't get into the group think, wow, these analysts I've talked about, they're not a lot of individuals you want to be friends with in junior high school and high school, and the backbone's not
But
there.
it's a very worthwhile caveat, though, because this is ultimately still a story stock, right? And like we've always talked about how Tesla's worth multiples of, any car maker, like it's 10 or 11 or 12 Fords right now. And so the question of how far can it drop? Like if that story goes off the rails, if you have someone like Dan on the air talking about how the call is a train wreck quarter after quarter, yes, there is more room to fall. So if you're holding the stock or if you're thinking about getting in now, like you're crossing your fingers and hoping it can't drop anymore. But when we talk about the bottom, I think, Josh, you bring up a really great point. Like we may be there, but there's also a chance that we might not. And that's scary if you're holding Tesla.
We'll have plenty of time on future calls to talk about the Optimus robot, the Cybertruck, and Dojo, and some of the more ambitious initiatives. But in the interest of time, Dan, you made a top 10 list for Musk to turn around Tesla. Maybe pick out one or two of those real quick.
I mean, one is the buyback. I mean, because in my opinion, look, Meta did a dividend, right? The point is you got to put a buyback line to stand. $30 billion of cash, I think $10 billion. Just for starters, even if it's just the press release and you just do it, a few sort of, every quarter, you got to do that. And two, I think lay out the AI initiative. This story is about AI. We even saw Cook talk about AI for Apple on the call. You got to lay out the initiatives and some targets for the street. That's the key. I think that's worth $1 trillion to $1.5 trillion alone outside the car company.
What did you think about his 25%?
It's in Musk's best interest. That's how I wanted to ask about that, Michael. It's in Musk's best interest, the buyback, shrink the float, his proportion of both the votes and the economic interest in the company grow commensurate with the shrinkage of shares. I know that's not all he wants, but it's in the right direction.
Well, of course, and then now the whole Delaware tax system is that. I mean, now they're going to incorporate in tax, and they're going to move Delaware board. It's going to supersede the 2018 comp package, give them another package, get them to 25%. And look, some investors, they'll talk about, it's ridiculous. He sold to buy X. Look, 60 to 70% of the value of Tesla is Musk. Musk is Tesla. Tesla is Musk. That's the reality. And you need him locked in with all the AI initiatives.
When he made that deal in 2018, the market cap of Tesla was sub 60 billion. Now it's 580 billion. And it's been higher. So even if you dislike hearing a number like a $55 billion pay package, you do have to keep in mind that that's in the context of a 10X.
And all incentive based. That's what you want with management.
Yeah, he made the bet. All right.
There we go.
Sounds like we're moving on.
All right, moving on to Alphabet. Let's throw up this chart from Consensus Gurus, please, John. So this shows the forward PE going into the print. It's 21 times, which is a little bit higher than it had been in the last couple of quarters. Google, the stock has been a little bit rough, a little bit shaky, at least compared to its peer group. I'm comparing it to the Qs. I thought, let's get into some of the numbers before we get your thoughts on the quarter. All right, this is from the CFO. For the full year 2023, free cash flow was $69 billion. Very nice. We repurchased a total of $62 billion of our Class A C shares. Google Services revenue was $76 billion, up 12%. Google Search and other advertising revenues of $48 billion in the quarter were up 13%. YouTube advertising revenues of $9.2 billion were up 16%. Full year revenue of $33 billion was up 26% for the prior year. The market did not like it. Now it's short term, but the stock was down 7% the next day. Alex, let's start with you. What did you hear on the call? Were you surprised? If you didn't see the stock price, what would you have guessed the reaction to the call would have been?
Yeah, I think that the numbers were. I think the numbers were terrific, but the things that you heard within the call were concerning. So Google added, I think it was like $6 billion in incremental ad revenue in the quarter, right? So that would make, and this is from Brian Weiser, who writes this great Substack, Madison and Wall, that would be the 11th biggest ad business by itself in the world outside of China. And there was this long-running meme that Google couldn't continue to grow like this because the numbers were so high. Like you're growing off such a high base, digital advertising was shrinking. Yeah, they missed a tiny bit on projections, but not by more than a hairline. And the fact that they're able to grow like this is incredible. But when you hear them talking on the call, what stood out to me was Sundar, first of all, talking about generative AI, not talking about how the company is leading. He was saying that they responded. I'm happy with how we responded. What? You're Google. You invented this shit. Like, you can't respond here. You need a lead. And even if you don't think you're leading, you never frame it as a response. So I would be freaking out now, especially because that does challenge that core business of search. And then the president, Ruth Porat, admitted that there were cultural issues, talking about the reason why that they're doing these layoffs, continued layoffs, is not because of margin, but because they're trying to cut layers out of the company to help improve the velocity to ship.
And it sounds like Meta to me.
Oh my God.
2 years ago.
And it worked for Meta, but I think Google's even slower than Meta. And we never had I've never really had Meta come out and say, we're not shipping fast enough. You know, they talk about year of efficiency. We want to get margins better for investors. For Google to come out on the call and admit that the shipping velocity is not where it needs to be, that it's responding to competitors, that's to me where the red flags were. But the numbers look good.
Do you think that they want, is that a message for Wall Street, or is it really a coded message for their own executives?
Oh, that is a good question. I mean, I think both, right? It's like, if you're within the company, you know at this point, it's shape up or ship out. And now we're explicitly telling the street that you're going to have to get the job done or you're toast.
Dan, Google was up.
Josh, so you're just that last question. I think that was also a little coded message toward Wall Street. It was a little more mea culpa. We recognize it. To Alex's point, we're going at it. They needed to do a little of that, I think, too, on the call.
So I wanted to say that the stock sold off 8% after reporting this number. But the performance of the stock going into the number is a really big part of the story. Alphabet was up 15% over the 6 months heading into the number and up 56% over the year prior. So, you know, it's not as though Wall Street has given them no credit on efficiency and streamlining efforts.
But I want to get Alex's view. I'm super interested. It's like, to me, the AI Google Cloud story is the reason you own the stock. I think the huge upside here is that they start to monetize, and we'll talk about Nadella and what's happened at Redmond. They start to monetize that Google Cloud story with AI, with the amount of engineers that are within Google headquarters. I think that adds $34 per share to the story.
Does anyone have more data on Earth than Alphabet to incorporate into AI?
Well, Facebook just said it does. I mean, in Facebook's earnings call, they say they have more data to train on than the Common Crawl, which is like petabytes of data, which I can't even fathom. Like, the human brain can't imagine how much data that is. So, like, and it's all theirs. It's all proprietary. They don't need to go to the open web or make any licensing deals with publications. But look, I'm not going to say that Google doesn't have any data. They have plenty, and they should be in good shape here. The question is whether they can convert it in the way that their competitors have been able to, and we don't know that yet.
Convert it and incorporate it.
Sorry?
Just as
convert it and put it into their. Yeah. I'm sorry. Convert it, but like incorporate it into products. And they claim they're already doing that, and they've been doing that without celebrating it on the ad side, which I'm sure they have, because it benefits them. Why would they not do that?
So advertising
we might not
revenue,
see everything they're doing.
Advertising revenue, at least from YouTube, which is obviously a huge portion of their business. By the way, YouTube revenue has doubled from pre-pandemic, from $15 billion, this is from Alex Morris, to $31 billion. But if you look at that chart, that's really gone sideways for the last, 8 quarters. And there was a monster breakout. And I think one of the reasons that I'd like to hear your opinion on this, guys, is that they said on the call, we've invested in a full suite of tools, including our new YouTube Create app for Shorts, to help people make everything from 15-second shorts to 15-minute videos or 15-hour live streams. Gen AI is supercharging these capabilities. Anyone with a phone can swap in a new backdrop, remove background extras, translate their video into dozens of languages, all without a big studio budget. We continue to grow watch time across YouTube with strong growth in Shorts and connected TV. Shorts remains a top priority. We have 2 billion plus logged in users every month, and we are averaging 70 billion in daily views.
It's crazy.
So that chart that you put up is really revealing, because I think what it shows is YouTube actually converting more of its watch time from the long form to the short form video, right? So it seems like a large portion of the user base naturally gravitated to the TikTok copy, which is shorts, and moved away from the longer videos. And this happens whenever a company introduces a new ad format. You see this surge of usage. It's like first reaction is, should we try to make money off of this? Not until it's at scale. Then it gets at scale and it's like, okay, we should make money off of it, but then it's how. And it's a scramble for these companies to try to figure out how to do it. And that happened with Meta. You could argue that Reels right now is getting close to or about to surpass the size of TikTok. It's massive. And Meta just now talked about how the money that they're getting on Reels is meaningfully contributing to revenue. And so that I think what that chart that we just showed with YouTube tells that exact story, which is that there was a lot of growth. The ad revenue looked flat, but it was misleading because they were ramping up a way to make money off of these videos. Now they figured it out. And that's what's taken the time. So they're going to talk a lot about how, everybody wants AI in their story. We use AI to create these videos. I think that's a sideshow. I think the real thing is that their sales team finally ramped and was able to sell this stuff, and they're crushing it.
I just want to say, and now, like, I'm Alex's biggest fan. He sometimes
that being
picks up
said,
things. he picks up things that the street doesn't see. What he just hit there, in my opinion, that was probably the most important thing from that conference call.
What, that the sales team is now good at selling shorts?
That in terms of the broader story and where they're actually going to monetize. And I think the street is not giving credit for what they're going to do. They became so focused myopically on what was happening. They're not giving credit, which I think we sit here 6 months from now. And in my opinion, Alphabet is a stock that is going to on its way to approaching 200.
Do you have a target on Alphabet?
160.
160. Did you move it after this earnings report or no?
Because in my view, the story doesn't change. Just like I didn't move Apple. Story doesn't.
Before the bell rings, Moffett-Nathanson has a thesis where YouTube becomes the new cable bundle, meaning enough people subscribe to you. How many? They have 100 million subscribers to YouTube. Did I hear the right number? They get to a critical mass, and they can now say, how about if we put all of the channels that you want and all the apps here centrally on your Google account, and we'll just pay them for you. And of course, Amazon's going to try to do the same thing with Prime. Like, where do you have these two companies? Are they neck and neck, or is one have an advantage over the other to be the new hub of everybody's viewing habits?
I'll say,
I think YouTube. Yeah, go ahead.
I'll just say quickly, I think it could work. Like, they have the NFL, they have Sunday Ticket. They're also fairly neutral, like, compared to a lot of these others. Like, their whole goal is just to deliver content to people versus having their own production house like Amazon does. So if it's going to happen with one of them, it would happen with Google. I think it's a good call.
All right. Moving on to Microsoft. The stock has been just an absolute juggernaut, up 62% in the last year. Blowout numbers as we've become accustomed to. Here's just throw up that consensus gurus chart. Just beats on revenue, on margins, on operating income, earnings per share. Just beats. Satya Nadella opened up the call saying it was a record quarter driven by the continued strength of Microsoft Cloud, which surpassed $33 billion in revenue, up 24%. Unbelievable. We have moved from talking about AI to applying AI at scale. By infusing AI across every layer of our tech stack, we are winning new customers and helping drive new benefits and productivity gains. There's no doubt about it that AI was a huge theme of this call. Dan, what did you hear?
The revolution's real in terms of AI. I mean, the monetization that we're seeing with Copilot, with Azure, with Cloud, it started. And that's why when you look at Microsoft, I mean, I think that's a transcript you print off, you keep in your back pocket. And anytime someone says the AI is hype, just take it out and say, one, you read that transcript, which I think should be put in the Louvre, because this shows the actual cloud acceleration that's going to happen is a game changer, not just for Microsoft, but eventually for Amazon, for Google. And the use cases are exploding, and they're leading the charge in revenue.
Why is the Azure cloud growing twice as fast as the Amazon cloud? I know we're not going to do Amazon yet, but what's going on?
I mean, okay, and now look, partially there's a law of numbers, right? Amazon still, call it 25% bigger. But the biggest thing is that enterprise workloads, the backyard of Microsoft, now you're going into the sweet spot. So This is their territory. This is where they play. And when it comes to AI, I mean, they're obviously, Amazon's nowhere near where they are.
Alex, last time we had you on, you were a little bit, correct me if I'm wrong, you were a little bit skeptical about all the claims about what they were doing with GitHub and integrating this. Have you changed your tune, or am I misremembering what you were saying last time we had you on?
Yeah, I'm changing my tune. I think GitHub, right, the thing that was going on with GitHub was they were talking about how it was helping all these engineers code, but then when I was actually speaking with CEOs about the uplift they were getting from GitHub Copilot, nobody concretely said, yes, this is making my engineers better. Now I'm starting to hear more CEOs talk about how this is making their engineers better. And that is a pretty positive sign for this Copilot. Now, it could be something that they say we're going to try out. The Microsoft sales is pretty convincing. They say you have a chance of making all your engineers 10x engineers. Why not try it for a couple of months? We'll give you a discount on the license, give it a shot. Microsoft has nice numbers to report at the quarter. So I'm not saying this is absolutely, it's going to happen. It's going to have staying power for certain, but it's certainly a positive sign there. I have a question for you guys. All right, so we talk about the AI growth, right? There's like 53,000 open Azure AI clients, and 1/3 of them are new to Azure. So, and I mean, Dan, I'm hearing what you're saying. I'm curious.
What will the churn rate be?
Well, here's the other question that I'm going to ask. If you have $200 to put it down on one stock, are you going to put it down? Are you going to bet on Satya Nadella and his
Bitcoin.
AI, or are you going to outside of Bitcoin? Are you going to bet on Satya Nadella and his AI, or are you going to bet on Tim Cook and the Vision Pro?
Ooh,
Look, I mean,
can't say both, Dan.
Yeah, go, Mike. Yeah.
in the short term, it's not the Vision Pro. There's no way.
Yeah, I agree. I mean, look, right now, enterprise AI. I mean, obviously the godfather of AI, Jensen, NVIDIA leading it. But when you look what Nadella's doing in Redmond, they should start building a statue for him.
What does this headline mean? Accenture alone will roll out GitHub Copilot to 50,000 of its developers this year. Are these developers working for Accenture, or are these Accenture client developers?
Josh, this is the story that we were just talking about. And what are your thoughts?
Right. But whose developers are those? Are those customers of Accenture that they are placing onto GitHub Copilot, or is this their own employees?
This is their own.
Oh, it's their own.
Because Josh, right now about 25% of all of Accenture, their whole sole focus, that Julie, the way that she transformed it, is AI.
Right.
Like in terms of that's their job.
Yeah.
So now they're going to do that. Yeah.
I'm sorry, Dan. Just in the interest of time, here's the quote. Overall, we are seeing this from Satya Nadella. Overall, we are seeing larger and more strategic Azure deals with an increase in the number of billion-dollar-plus Azure commitments. Vodafone, for example, and John, get ready with that chart, please. Vodafone, for example, will invest $1.5 billion in cloud and AI services over the next 10 years as it works to transform the digital experience of more than 300 million customers. This is not slowing down. And you talk about, I know people say on TV, the law of large numbers. That's not what this means, but it is staggering. We're looking at Microsoft Cloud run rate revenues. It is staggering the size of these numbers and the fact that they're not slowing down.
And they're not going to slow down. And this is, and Alex, this is a question to you, because obviously you're always doing so many of your checks. Right now, there's almost a time. In other words, like as a customer, if you don't sign the dotted line for Copilot, you go to the back of the line. You won't be able to deploy till the end of 25 because of the shortages. So there's a huge pressure for CIOs to actually sign up. I mean, Alex, don't you know that's dynamic right now in terms of going to the back of the line for Microsoft?
Definitely. Yeah, it seems like they're going to definitely press the scarcity issue. And more than that, like if you look at that chart we were just looking at, the growth, I was just speaking to somebody who's working within cloud, and they were talking about how we keep hearing about, okay, maybe Amazon and Microsoft are going to peter out. And I was like, who's going to win this one? And they were very bullish that it's going to be both companies. And the point that they're making is we're only about 40% of the way there on cloud. So another 60% of growth yet to be realized as we move computing infrastructure.
Do you
towards
guys
the cloud.
think most Fortune 500 companies will opt for a structure that allows them to utilize either so that they don't get stuck in the ecosystem of one or the other? Or does the
like a
pressure from
hybrid
Microsoft
cloud?
force people to say, hey, we're an Azure shop and that's just what we're building?
Long term, I think everybody goes
Yeah.
cloud. I mean, the cloud will learn to solve the problems that are being solved with the on-prem software today. I don't know how long that long term
and
is.
Josh, I'd say probably about 30% of them go hybrid, which basically means they can go about 70% of them they go full Azure, because otherwise, if you just dip the toe in the water, you're not going to get the full set of their product.
We haven't
Okay,
even
so
said
now
anything.
is the time they're going to commit. Like they're going to decide
Yes.
we're an Azure AI
Right now.
customer. This is how we're building it for that platform.
Could you imagine being a CIO?
And that's why what Alex
Yeah.
talked about with Sundar, that's why it's so important that Alex that they need to get
That lock-in is the key to the next 10 years of earnings visibility.
I was just going to say, could you imagine being a CIO and going back to your CEO and being like, no, we're not going to invest in these AI products? Like it becomes a peer pressure thing. You're going to get fired. If you don't
It could
do
be
that.
your job, right?
So
Really good
last
point.
thing before we
Yeah.
move off, we haven't even spoken about Office or anything like that. LinkedIn's got 1 billion members. I mean, unbelievable. Here's a quote. This quarter, we set all-time records for monthly active users in Xbox. I mean, out of all of the big tech companies, is Microsoft not the conglomerate?
It is.
All right, moving on to Meta. I mean, this is why we play the game, right? This is why we lace them up. Unbelievable. Let's just start with the market cap. John, chart on, please. The market cap, I think it peaked out at about a trillion prior to the spectacular 75% decline. I don't think there's ever been a chart like this. In fact, I'm just going to say there's never been a chart like this, where you've got $1 trillion company, even adjusted for inflation, lose 75% of its value and then gain 300% or whatever it did over the subsequent 18 months and make a new all-time high.
Never. It's never happened before.
It's never happened. There was just beats across the board. I just want to run through a few charts and then we'll turn over to you guys. So advertising revenue by geography. Again, very much like the YouTube chart that we showed earlier and Google's advertising, this was in a bear market. Advertising was in a bear market. There was a lot of headwinds, which we don't need to get into right now, but those headwinds have abated, and there was a monster breakout in advertising revenue just across the board. And then expenses as a percentage of revenue. We know all about the cost cutting and the year of efficiency. This has gone way down. Credit to Zuckerberg and the entire team there. As a result, you have net income just skyrocketing, leading to a 20%, $200 billion move today. And then lastly, the average revenue per person in the family of Facebook or Meta companies. Again, it's a breakout. I was with Josh last night, chart off please, was with Josh last night going over this report, and I'm just like, the charts, I mean, what a story. Dan, we'll start with you. Talk about Facebook's incredible quarter, Meta's.
I mean, I think this is really a comeback. It's historic, right? I mean, if you look at the subscriber growth, what they're spending per dollar of revenue, we've never seen a tech company at this scale be able to do it. And the monetization from a digital advertising, the rebound, I think numbers could still go up another 15, 20%. That's why, from a stock perspective, many now looking, okay, could you start to get to 550, 600? Given the trajectory where numbers go, then you do the dividend. That's just another sign for where you see this thing going from a confidence perspective. I mean, just an unbelievable quarter.
Could there
Alex?
be anything sweeter for Mark Zuckerberg than on the day that Tim Cook releases the Vision Pro, which he talks about like he's seen God in, right? Meta stock is up 20%. Meta has the leading device. Meta has no China overhang. We don't think that the Vision Pro is going to amount to anything more than $4 billion over the next 4 years. And he's beaten Tim Cook's ad embargo. I mean, it's a spike the football moment for Meta.
What's so incredible to me, a lot of people try to ignore the technology and focus on the fundamentals in terms of like the earnings and cash flows to arrive at their opinion. And if they did that yesterday, then they would have said, okay, Apple 30 times, Facebook 35 times. I'll buy the cheaper one into earning. Like if we try to reduce what's going on at these companies to financial statistics only, we lose. Same thing on performance. If we try to play this game where everything's already baked in, well, here was the setup going into Meta last night. Meta was up 22% over the last 6 months, up 158% over the last year. A very lazy analysis that you could have conducted would have been to say it's 35 times earnings and it's up 160% since this time last year. All the great things going on at Meta are probably priced in. And then it goes up 20% today. So maybe not. That's the remarkable part of this. Yeah, what are you going to tell me now?
Hey, Dan, I want to ask you this, just piggybacking on Josh's point. John, throw up the chart from Consensus Gurus. I want to talk about the dynamic where analysts could be so far off the mark and then what happens subsequently. So very specifically over here, so operating margin, the analysts were estimating 33.8%. It was 40.8%. So a monster 700 basis point beat. How is it that the consensus can be so wrong, and then talk about what happens next? Like, so analysts after last night, they go back, they update their models, they come out with new price targets. The streets reacted. Talk about all of those dynamics.
Yeah, I mean, because a lot of times, like, companies give guidance, you talk to them during the quarter, and you tend to get in a very tight band where numbers go. And this is one, they just blew it out of the water. I mean, it was no one, even the whispers and the bull kids, no one ever thought you'd have this type of beat above 40%. And then you go back to your model and you start to trajectory it out. But then what a lot of analysts do, including ourselves, is that you're going to still give them what I view as like conservative targets where you don't want to set the bar too high because you don't want to just trajectory this to the next 3-4 quarters, because then you could ultimately, I think that puts companies maybe back against the wall. But it's an aha moment, right, from an analyst perspective.
Alex, what's crazy is Facebook in 2022 were spending like there was no tomorrow while the ad business was slowing down. And it's an advertising company, let's face it. Tech-enabled, but it's advertising. This last year is the opposite. The ad market is recovering and their spending is going down. Like sometimes it's that simple. And I know there's a lot of other, more sophisticated things happening. But if you distill down the drivers of the stock, more revenue, less spending, stock go up. And that's exactly and this quarter is obviously, and of course it helps. They have the glasses on the market. They beat Apple to wearable, that wearable format. But that's pretty simple stuff, right?
Definitely. I mean, their expenses were down 22% over the year. Their profit was up $10 billion year over year on the quarter. That's insane.
Unbelievable. Right. All right, we've only got Dan for 10 more minutes, so I just want to make sure that we're in the interest of time. Let's just move off of Meta and onto Apple. So Apple, the stock, opened down 4% on the day. The revenue is really not growing that much, if really at all. China was not great, to say the least. Interestingly, the stock opened down 4% and is now positive on the day. Let's just quickly get into some of the charts here. So it was a mixed bag. They beat on revenue, but they missed on services. Obviously, that's a big one. And then if you just look at the revenue change year over year, iPhone is low single digits. Services has come down dramatically from where it was. And of course, this is the engine of all the growth. These are where all of the margins are. Alex, what did you see out of Apple's most recent quarter?
So the thing that struck me the most on this one was that they gave this guidance for the next quarter that said a lot of the sales last year actually happened in the March quarter that we initially anticipated happening in the quarter ending at the end of the year. And so therefore, they're expecting another quarter of revenue decline in the March quarter this year because of the higher comps. So you look at the big picture from Apple then, and you have 4 straight quarters of revenue declines. This year, this quarter, the revenue went up, but you have to factor in that it was going against easier comps because a lot of those iPhones were pushed into the next quarter. And next quarter, it's gonna potentially shrink again 5%. So when you think about Apple, I mean, yes, part of that is because of China, but overall, that's pretty concerning to me looking at like where this company is going. Now you could say, and I'm sure Dan will say that it's because people are holding on to their iPhones longer and they have a larger install base. And, maybe it's good. Like we should maybe celebrate companies that have products that actually last for more than 2 years. But that being said, it's going to be a serious problem that Apple's going to have to deal with over the next few quarters.
Dan, what do you think?
So look, I mean, we didn't change our target this morning, and it was definitely a lot of sort of hand-holding early this morning, talking to investors and last night. Because my view, look, Alex raises great points. China down 13%, clearly a headwind. It's not champagne or rose in Shanghai. But if you look at units this quarter, they beat from an iPhone perspective. Our checks continue to show 215 to 220 million units for the year. The March guidance, clearly that was confusing. And I think definitely a little anomalous the way that they kind of talked about it. But for the first time, Cook talked about AI. We've talked about it. This is the AI app store that we expect to come later this year. AI technology baked into iPhone 16. The active user base we thought was going to be 2.1 billion is 2.2. So 200 million more users. Now you're going to have AI into that user base. You start to see a China number that even shows any growth second half of the year. This stock, in my opinion, is 225 off to the races. So look, the point is, it's going to sharpen the knives from a bull-bear debate, but it's hard to bet against what they've been able to do, and they've had challenges in China before.
Is AI actually a risk to Apple? And hear me out on this one, right? Because this could change the way that we interact with our devices. Like we all saw that the winner of CES, as far as press attention goes, was the Rabbit, which was this AI device that could basically allow you to talk to your apps. So when we hear, I heard, okay, Tim Cook finally said, the 2 letters AI. That's cool, but is that necessarily a win for Apple? I don't know.
Well, I think, but Alex, that point, you've talked about, I think that's why, like, you look at Vision Pro, what I view is kind of the start of a new form factor. I think 2 years from now, that's sub $1,500, looks like sunglasses. And then this AI app store, it's all about monetizing the install base. And then they're going to put more AI into iPhone 16. So I'm just viewing it as more, I'm not going to sell Apple on a quarter guidance. And ultimately on that guidance, if you looked up sandbag special, SBS, in the dictionary, you'd have that guidance from March for Apple.
Dan, before we let you get out of here, and thank you for hopping on in an airport to catch your plane, how do you think about Apple in relation to some of its other big technology competitors? How excited or unexcited are you about them versus their peers?
Look, I think longer term, it's probably the most excited we are for any company relative to now tapping into an install base of new form factors and AI and where this next renaissance of growth is happening. In the near term, it's much easier to pound the table, and the stocks that likely move higher in the near term, it's Microsoft, it's Meta, it's Amazon. In terms of right now, the one that has headwinds, where I have to do more of a 40-minute call with investors versus a 5-minute, it's Microsoft and Tesla.
So if this stock doesn't grow in the next 4 quarters, can it keep its 30 multiple, or are we going to see some contraction there?
I think you'll see contraction, but I believe it does start to grow to that point. Services is key to the valuation, double-digit growth, and then that AI component starts to hit. And I think we look back at Apple today like we did Meta 18 months ago. That's the call.
Dan, thanks so much, man. We really appreciate the time. Safe travels.
No, thanks for having
Safe flight.
me.
We're gonna stick around with Alex, and we'll take Amazon, and you'll listen to it later. All right. Dan Ives, ladies and gentlemen.
Dan's the man.
Alex, you enjoying yourself?
Love this. It's always great talking with you guys.
We're going to wrap with Amazon, which is a stock that I own, full disclosure. Amazon coming into earnings or coming out of earnings, it's kind of traded like shit. Chart on, please, John. So the last 2 quarters, actually now 3. Okay, I take it back, maybe. including today, and then the prior 2 quarters, it was up 7%. So not bad. But prior to that, 2021 was rough. 2022 was rough. It's up 7% today.
It's one of the furthest of this group away from its all-time high from 2021. Other than Tesla, all the rest have either since made new highs or are very close to those prior highs. Amazon's still a way off the pandemic sugar high and hasn't found its way back yet.
All right, so let's look at this chart from GeekWire showing Amazon net sales by business segment. I asked Dan earlier if Microsoft is a conglomerate. Amazon can make a case as well. Of course, you've got the core business, online sales, online stores, which looks like it's about record highs. Third-party seller services, oh my God. The big one, though, is advertising. So here's from the call. And of course, we'll get into AWS, but advertising from the call. Alongside our stores business, our advertising growth remains strong, up 26% year over year.
Ramping.
Which is, primarily driven by our sponsored ads. We've recently added sponsored TV to this offering in the US, which, Alex, I know that you've been talking about. So this happened to me actually 2 days ago, where I turned on my Prime, and it said, do you want to use the ad-free version? If so, you have to pay whatever it is. I think $3. Is it $3 a month? Alex, what was your thoughts on Amazon's most recent quarter?
Yeah, I thought it was impressive for a number of reasons. First of all, it turned the biggest profit in their history, $13.2 billion. We know Amazon has kind of been profit averse for a while, but it really just shows the shift of the company. And you look at those retail numbers on the chart, and they're kind of now at par with where they were in the COVID era, which is okay. But this stuff was supposed to change consumer behavior forever, and it hasn't. And they're kind of now flat from the COVID era. But the areas of growth are the high margin areas. You're talking about AWS, and you're also talking about advertising, which is like found money for them. So Amazon's in the process of transforming as a company. We just ran a story about the makeup of its senior leadership team, which has almost doubled under Andy Jassy. When you've had a lot of the retail folks have exited and they've been replaced. But what you've had is a run up in the folks who represent divisions like logistics and Amazon Web Services and all of these entertainment services. Like AWS used to have 2 people on the senior leadership team at Amazon in Bezos' era. Now it has 5. So we really see that this is going to be a much more profitable company moving forward. And if you're looking at the era that we're in, we're not going back to zero interest rate environments. So you need to show some profit, and that's a very bullish thing for Amazon.
This is another company that is now applying AI to their existing businesses to either grow them or boost profitability. They said they launched something called Rufus, which is an expert shopping assistant.
I love Rufus.
Trained on our product and customer data that represents a significant experience improvement for customers for discovery. So while you're shopping, Rufus is operating alongside of you or in the background, and it will help you arrive at the right product to buy. Is it as simple as that?
Even
better. I felt like they were already doing that kind of.
You go to the search bar and you start to have a conversation with Amazon. Please help me compare 2 different coffee grinders. And it will then lay them out for you. And why I like Rufus so much is because
every Prime user has access to that? You could do that right now?
I'm not 100% sure what the rollout schedule is, but I imagine this is going to go to every Amazon user, not just Prime users. And the reason is, and Amazon knows this, is that the retail experience on Amazon is a mess. It's so much harder now to find the product that you want, comb through everything, and this might help solve it. The only question is, does it then hurt that ad business that we like so much, right? 26% growth in the ad business, that's where a lot of the profitability is coming from. They'll have the same problem that Google has to contend with.
Yeah, they almost have they almost have trapped themselves. I was going to say Google search and Amazon's product pages, where the more clutter, the more potential ad revenue, but the less customer satisfaction. And if you go back in time 20 years, the hallmark of Jeff Bezos building Amazon was whatever makes the customer happy is the right answer. And Google beat all of the other search engines because of its simplicity. It was a plain white page and it worked. So they almost seem to be fighting the very thing that made them both successful, because now you've got 2 different competing business interests, ads versus commerce. Is that how you see it?
Yeah, but I also love the fact that Amazon is doing this. And it kind of goes back to what we talked about earlier with Sundar Pichai talking about how Google responded and others lead the way. Look, and the internet, it's very easy to build. So if you don't lead the way, somebody else is going to. And then on your earnings call, you tell Wall Street that you responded versus led. And
Nobody wants to
Amazon
say
isn't
that
waiting
word.
for that moment.
Yeah.
Yeah.
Alex, one of the reasons why Amazon, the stock, had been under pressure is AWS growth really decelerated. And it seemed to be ramping up a bit, at least in the most recent quarter, broke out of the sideways range that it's been in on the revenue side. How is AWS positioned versus some of its other cloud competitors?
Well, it's the biggest company of them all, right? It's bigger than Google. It's bigger than Microsoft. It's, it has more features, more functionality. And you're right, it did grow. It ticked up from 12% to 13% growth. So that's a really positive sign for it. But there is definite liability there, right? Because the one who's really growing and the one who has the potential to grow even more is Microsoft. They have all those relationships with those stodgy enterprise companies that have been with Microsoft forever, and they're just upselling them. And so that's why you see the Microsoft growth rate so much higher than the Amazon growth rate. Yes, law of large numbers, but also just so much more runway for Microsoft. And I don't think Amazon is worried yet, but over time, could there be a worry? Absolutely.
Alex Kantrowitz of Big Technology, that was incredible. Thank you so much. You kicked ass. Appreciate the time.
Great to see you guys as always.
Thanks for hanging with us, Alex. Go do your thing. We'll come back to you next quarter.
Sounds great. Can't wait.
All right.
Good quarter,
Awesome.
guys.
Great quarter,
guys.
All right, we're going to wrap with this. Here's a great chart from Alex Morris showing the cumulative research and development expenses for Apple, Google, Meta, and Microsoft. That was $141 billion in the fiscal year 2023. Josh, these numbers are not slowing down. We spoke about all of the spend that not just these companies are doing, but their customers, how much they're spending on all of their platforms. The future, I mean, I know that these companies are big, but the future is extremely bright for these companies.
Put that chart up real quick. So this is showing the amount of R&D that these companies are doing, and the thing to keep in, while it's sextupled over the last decade, the thing to keep in mind is, what are they spending the money on? And so in addition to paying close attention to the companies we've just talked about, in addition to paying attention to them as investments in and of themselves, paying attention to how they're spending money and on what helps us identify other areas that people will be making money on alongside of them. And that's why these companies are so crucial. It's not just about 6 or 7 ticker symbols. It's about an entire technology revolution and all of the companies and jobs and opportunity in this new ecosystem that's coming to life. So that's why we're so excited about the concept.
We opened the show with what ultimately drives markets, and there's no doubt, I don't think even bears would have anything to say against this, that these companies are going to continue to grow. The fun part, it's not good or bad, it's better or worse. Are they going to continue to exceed expectations and reward their shareholders? Of course, that's the question that just remains to be seen.
Michael, I want to congratulate you on the quarter. Let's take everybody out. And and guys, we will, if this is successful and you guys give us the kind of feedback that you like the show, we'll see you this time next quarter.